Very good evening to all of you. On behalf of Auditing and Assurance Standards Board of Institute of Chartered Accountants of India, I welcome you all in today's 160th CP program organized by AASB of ICI for this council year. Today's 160th program, we have covered all the sectors, all the industries. So today we are going to cover a very important sector, that is the IT sector. And in order to tackle this very important sector, we are having with us Sri Shraddha Kivsara, madam. So on behalf of AASB of ICI, I extend my heartiest welcome to you, ma'am. Namaste. Welcome to you this 160th program organized by AASB of ICI. We are having with us Pooja Sharma, madam, as a moderator for today's webinar. I also welcome Pooja, madam. So I request Pooja Sharma, madam, to please kindly start the proceedings of the today's webinar. Over to you, Pooja, madam, please.
Yeah, thank you, Lal sir, and thank you to AASB for providing, an opportunity to connect with other fellow members and hear eminent speakers on the relevant topics which are relevant for the profession and the colleagues like us. So definitely, as Lal sir and AASB, this webinar is very important, and because we've covered different sectors, and IT sector also, have a great place because it is a growing sector, and there are a lot of challenges in the audit and consideration that have to be kept in mind while conducting an audit of the IT sector, basically. So I welcome Shraddha ma'am there, and heartiest welcome, ma'am. So I'd like to introduce you all of you to Shraddha Kivsara. She's a chartered accountant with expertise in leading teams in conducting stat audit for large and complex clients, and she's a company secretary as well with more than 15 years of experience. So she has managed, audits of large listed group companies which are part of Sensex 30 and Nifty 50 as well, and she's member of WIC committee of auditing standard. Not taking too much of your time, I'll ask Shraddha ma'am to please go ahead and take the presentation for all of us and share your key points with us. Thank you, ma'am.
Yeah. Thank you, Pooja ma'am. Thank you, Anil sir. And I would like to start the presentation thanking AASB to give me this opportunity to have a discussion with all of you today on this very important topic, which is regarding key audit consideration when you audit any IT companies. So I'll just share my screen and then we'll start the deliberation. So is my screen visible, Pooja ma'am?
Yes, madam.
Yeah, okay. So once again, a very good evening to all of you. And wish you, I think the Christmas is already over. So in advance, I'll wish you a very happy new year. Now the question comes why we have gathered today here for discussion on a sector like an IT sector, correct? So if we look at the Indian economy standpoint, India is any which way is known to be I would say a very big contributor when it comes to global contribution or export of services. So IT services are I would say, has earned us a very different place at even at a global footing. So from that perspective, IT industry is extremely important. Second important aspect is if you see the IT industry, the industry has evolved significantly in last 20 years. So IT industry is not a new one. It has its origin ideally from 1975. So around in 1970s, TCS was the company which was incorporated. So after TCS was incorporated, TCS got an order from a US based firm for supply of certain support engineers, and that's how the IT industry started in India. So those were very old days, pre 1995 era, where generally India used to be looked at as a place to outsource, I would say a low cost place, outsource work at lower cost. And even I would say, even though the talent pool was there, generally not very important processes or not very important aspects were outsourced to India. So that was the story pre 1995. Over a period of time, Indian IT industry proved its metal, I would say, proved its talent, proved its metal, and showed it to the global economy that how they can ideally contribute in a very different manner. So pre 1995, it was more looked at as an outsourcing work of low cost to a low cost country, and because the talent pool was easily available and it was a skilled talent pool. From 1995 to 2000, if you look at it, there was a lot of investment which was made by different global companies into R&D sector. So basically, after understanding that India has a very skilled talent pool, a lot of product development started happening that time in India. And that was the time when a lot of FDI started coming in India. So a lot of liberalization happened, FDI started coming in India, and IT sector then post 2000 gained a lot of dominance. So from 2000 to 2005, if you see, a lot of Indian IT companies grew. So not only in the terms of, I would say, their revenue, but size, the scope of services, they took themselves to different countries. So it basically the Indian companies started becoming multinational enterprises. So between 2005 to 2016, that was an era where there was a huge growth in the IT sector. So it was moving from an enterprise servicing to enterprise solution. So India became a multinational companies for any IT company. India was a favorite destination, and firms in India or companies in India became multinational players with delivery centers across the globe. So you will find a huge delivery base in India, but the company would have presence in Europe, in US to procure different contracts. That's what significantly happened between 2015 to 2016. Now, 2017 onwards, now IT as a sector, though we say that the sector has been there since 1995, but the sector has evolved over a period of time. In today's world, where there's a lot of focus on digitalization, now after COVID, digitalization took place at a very, very rapid pace. So, COVID, in fact, explained us that why it is very important for us to embrace technology quickly, and the digitalization which otherwise would have happened in 5 to 10 years was quickly there for a lot of companies. So digitalization became an agenda for every CEO of the company. So with that, newer technologies started emerging. So today we all talk about AI. AI is no more new. Maybe 3 4 years back we used to talk about artificial intelligence will take over a lot of jobs, etc. Right now AI is there in our day to day lives. So the IT industry, the way some also significantly changed. So if you see from 2017 onwards, and today even we are talking about India's IT industry is almost $245 billion. So it employs around 5.4 million people, and it's a huge industry. And every year it at least adds around 2.5 to 3 lakh people in the sector every year. Other than that, if you look at it, India is the third largest startup ecosystem that way. So all startups you will see, a lot of startups today are into tech, are tech startups. So either they are working on AI, or they have products through the use of tech platforms. They are helping. So they are either marketplaces or they are tech platforms through which they are helping businesses to I would say work more efficiently, effectively. That is what is happening. So with all this fintech companies growing, tech companies growing, startup ecosystem, I would say being at its peak, India being the third largest startup ecosystem there, the revenue recognition and the IT companies' complexities has honestly increased over a period of time. So earlier were the days when there were only few services which were provided by IT companies. Now the domain, we will talk about it in detail. But now the domain or the umbrella of services has significantly increased. So considering all that, it is expected that by 2025, which is the coming year in next few days, we would be almost $350 billion in IT market. So India is any which ways an IT hub, which will further grow with the adoption of various technologies. So with all this, the sector's importance is extremely there, and because of that, because of so many companies being there in the IT space, we as an auditor, it is extremely important that we understand what are the risks which are associated with this sector, what are the key consideration which as an auditor you should place when you audit this sector, and what are the nuances which you should take care, how you should deal with those. That is the main agenda for today's discussion. Before we get into the technical topic, I would also like to highlight the significance of this sector to Indian economy. So we already spoke about India being an export hub for IT services. But the IT industry accounts for almost 7.5% of our GDP, which is expected to increase to 10% by 2025. So if we look at it, it's a huge contribution to GDP by this particular sector. The FDI flow has been very high in this sector, and the sector ranks almost second in the FDI flow. Plus, the opportunity pipeline is also very strong. Considering all these aspects, the significance of IT industry will be there in the coming future as well. Now, as I already touched upon it, that though the IT industry has been there for quite some time, there has been a lot of changes in the landscape of IT industry. If you talk about early 2000, we used to talk about either product based companies or services being provided. Now today there are n number of technological development. So today we have different subsectors within IT which different companies are provided, and because of which the landscape has changed significantly and the complexities has increased over a period of time. Now, over a period of time, one more thing has happened. Data privacy has gained extreme importance. So, you as UK has GDPR regulations, similarly, India is embracing a Data Protection Act very soon. So, I think the act is already out and it will be soon embraced by the country. So, considering that the regulate this sector will also to an extent become regulatory sector, not from a regulator standpoint, but per se there would be a lot of laws and regulations from a data protection per se, which the sector would also have to comply with. Other than that, with the emerging technology, there is another aspect which is very important, that these type of companies needs to keep on evolving themselves. So it's not about developing a product and then sitting for 10 years delivering that product or shipping that product to customers. It is about embracing this change and continuously innovating and evolving. So this is how the IT sector would have to keep on evolving. Now, as we spoke about IT sector's change in landscape, we will see generally you will find four types of IT companies. Either it would be a software development company, where either it would be developing a particular software, an application, or a website development, mobile app development. So basically, it's a core development company. Second type of company is cloud computing. Now, these are new age companies. You will find a lot of startups into cloud computing, a lot of settled companies as well into these cloud computing. Now, what is cloud computing all about? So, it is divided into various subsectors. If you look at it, software as a service, correct? So, if I have to give you an example, if you are subscribing to the Zoom, if you are subscribing to Adobe, you are using software as a service, correct? You are subscribing to it, you will pay subscription charges based on your usage, correct? That is software as a service. Then there are different platforms which service providers provide, correct, which can be used to provide services. So these are generally cloud platforms. So we are all aware about SAP. SAP is a very old ERP, a very mature ERP, but now SAP is available also on cloud. So not necessarily that the entire data or the SAP is hosted on company's premises or company's database. It can be even hosted on cloud. This is basically cloud acts as a platform wherein using that platform, you can use your products and a service can be delivered. So these are platform as a service. And then obviously there's an infrastructure as a service. So Amazon provide different web services. This is nothing but an infrastructure as a service. So you can use Amazon even to store your data. You can use Google Cloud to store your data. Various services also are provided by Amazon or Google. These are nothing but infrastructure as a service. So these are all new age companies which are somewhere using cloud computing, and that's where the complexities start coming in when we discuss about the audit or the revenue recognition model. Then comes the third type of companies, which is Internet of Things. Now, Internet of Things, if I have to very briefly explain, it is like using AI or smart technology in our day-to-day lives. So when you sit in your car, today your cars are connected with the infotainment system. It is nothing but Internet of Things. So there are n number of startups or n number of companies which are using Internet of Things to deliver the services. So that is another subsector within IT. And then obviously there is an hardware sector, selling of hardware, networking equipments. That is another sector in which an IT company can deal into. So broadly, if we talk about software development, cloud computing, Internet of Things, and other subsectors, these are four type of subsectors. So whenever you are auditing any IT company, the first thing which we do under audit is understanding the business of an entity, right? We first try and understand what exactly is the business of the entity, which sector does it operates into, who are its customer, which are the regulatory factors which are governing that entity, what type of geography does that entity operate into, what is the control environment, what are the accounting policies. This forms part of our auditing standard, which talks about understanding the business. So similarly, when you are auditing any IT company, the most important thing which you are required to do is understand the relevant sector in which this company is operating. So broadly, it would be an IT company, but you need to understand the business, whether they are providing resources to do certain services, whether they have a tool or a product which they sell to people, whether they are providing cloud software as a service. So basically, that understanding is extremely critical so that you can then understand the nuances of it. Every type of subsector will have different aspects attached to it. So the first and the foremost important thing is understand the relevant sector in which it operates. Then understand the regulatory factors. So basically, you need to understand what all regulate laws and regulations would become applicable to it. So generally, you will find in India, the way the IT companies have evolved, they will have a delivery center based out of India, but they will have presence in various locations. So either they will have subsidiaries or the parent company there in US, UK, or European countries. Correct. So even if you are auditing an Indian company, an IT hardcore IT company, you will find they have presence or they have entities across the globe, especially in US, UK, or Europe. So therefore, compliance with laws and regulation becomes very important because with presence in multiple sector, the applicability of laws and regulations is extremely important for the company to understand what all laws are there, what all regulations are there, and whether the company is complying with those laws and regulations. So regulatory factors is very, very important. And for that, it is also important that we understand the geography in which entity is operating. Another important aspect is entity selection and application of accounting policies and practices. So what all accounting policies have entity selected and applied? So whether an index is applicable, it's an entity which is governed under Indian GAAP. All that understanding is extremely critical to assess the revenue recognition model or to assess the accounting implication, auditing implication of various aspects. Another important aspect is entities control environment. So from an IT sector perspective, it is again important that you understand what is the control environment in which the entity is operating. What is the tone at the top? What is how those charged with governance are monitoring the entity, monitoring the performance of the business. So entire control environment understanding is extremely critical. So once you do a thorough understanding of business, that is when you will understand the key risks, I would say, or the risk of material misstatement which may arise when you are auditing that particular entity. Now, before we go to the risk of material misstatement, let us look at materiality because materiality has its own significance when you do audit for any company. So, a materiality threshold in audit refers to the benchmark which we use to obtain reasonable assurance that the audit does not detect any material misstatement. So whenever we determine the materiality, there is a auditing standard around how to determine the materiality. But if we have to talk about it briefly, we will have to evaluate what should be the benchmark which we should use when we decide the materiality. So for deciding the benchmark, generally you look at the intention or what are the users of financial statements interested in. So what are the key KPIs of the users of the financial statements? So for example, a large listed IT company, generally profitability would be the benchmark. But suppose there is a startup entity which may be newly set up entity, their revenue could also be a benchmark. Correct? So It depends on what focus the users of financial statements have. Who are the users of financial statements? What type of entity are you auditing? So, suppose it's a cost plus markup entity. It's a software company which is providing services, say, to its parent entity, and it is remunerated at cost plus markup basis. There, the total cost may become your would become your benchmark for deciding the materiality. So, basically, you will have to understand the business. You will have to understand the who are the users of financial statement and what is that they are focusing on, whether they are focusing on top line, whether profitability or EBITDA margins are the focus. That is what you need to assess, and basis that you will decide the benchmark. Basis the benchmark, then you can decide the threshold. What would be the threshold in determination of threshold? Risk assessment, past experience, control environment, all those aspects are required to be considered. So generally in a profit before tax is considered as a benchmark. 5 to 10% is the threshold which we apply to PBT to arrive at a overall materiality. In case of a revenue, it depends between 0.5 to 3%. So this all depends on the entity to entity and the other factors which influence the qualitative and quantitative assessment of materiality. So once you decide your materiality, this is an extremely important step. Then let's look at what are the key audit consideration. So what are those areas where there could be a risk of material misstatement or where there could be a potential of higher risk of material misstatement? So before you do a assessment of risk of material misstatement, you also need to assess the fraud triangle. You also need to look at the fraud risk assessment of that particular entity to see whether you come across any heightened area, any heightened risk of fraud because of any factors. So that is there in every audit, which you also need to do for any IT company. So now if we look at the risk of material misstatement, typically in an IT industry, revenue recognition is extremely critical. Now, it is critical in every company per se. So revenue is extremely important in every company. But in case of IT industry, there's a lot of complexity which is involved in determination of revenue recognition and specifically determination of timing of revenue recognition. So one is determination of amount involved, and second is determination of timing when the revenue should be recorded. That is extremely at times complex and judgmental, because of which revenue is a very key focus area in any IT company. Then, if we have to typically look at other areas which could lead to a risk of potential misstatement, generally IT companies do a lot of acquisitions. So they grow through acquisitions, and therefore you will find that IT companies every year or every alternate year you will find some acquisitions being done by them. So in case the IT company does any acquisition, then accounting for those business combinations is again a very complex aspect, and that also could be a risk of potential risk of material misstatement. So that should be your either your risk or your focus area for that particular year audit basis the complexity of the acquisition. Now, if entity has done acquisition in the past as well, and if there are a lot of intangible assets which are acquired through those acquisitions, or there is a goodwill which is recognized in the books on account of those acquisitions, then impairment assessment is a very, very important area which you need to focus on as an auditor, because the goodwill arising on account of acquisition needs to be tested for impairment annually. Correct? So that area becomes extremely important. We spoke about IT companies having, I would say, presence across the globe or presence in 2, 3 countries. So from that perspective, compliance with laws and regulation becomes extremely important. So you need to assess the geographical location in which the group operates and then assess the compliance, what all laws and regulations are applicable. And then you need to look at how management is ensuring compliance with those laws and regulations. So if an entity has a subsidiary in US, what is management doing to ensure compliance with US laws? That is what you need to first assess and then obtain comfort on compliance with laws and regulation. Another important aspect in, I would say that way it's there in every company, but and therefore in even in IT sector, in case company has a lot of transaction with related parties. So that becomes another potential risk of area of potential risk of material misstatement. So in case there are transactions with related parties, then that should be a key area. In case it's into the company is into a product development, or company generates some capitalizes some internally generated software, then the capitalization of that cost becomes an extremely important area. So revenue versus capitalization becomes an extremely important discussion as well as assessment as an auditor. Another important area is tax litigations or tax provisions. So since this entity operates in various jurisdictions, there are a lot of tax litigation in different jurisdictions. So that assessment, along with tax provisions and involvement of experts to determine the appropriateness of tax provision in those jurisdictions, again becomes an important area or area of focus. Another important aspect in IT industry audit is around information technology related controls. So since these are IT companies having complex systems, so it depends on size of company. If the size of company is comparatively large, it has complex IT systems basis which the transactions takes place, then information technology general controls become extremely important. So we will see, but basically you need to involve the experts to assess the ITGC effectiveness in such scenarios. So broadly, these are five, six areas or key audit considerations which we need to focus on when we assess the risk of material misstatement. Now let's look at how does the balance sheet of an IT company looks like. So what are major sources of revenue and expenses? So as we spoke about various subsectors, so similarly, revenue stream, there could be multiple revenue stream within a company. It all depend on the type of contracts which it enters into with its customer. So there could be a software sale, there could be subscription services, there could be professional services such as consulting being provided. In case of software which is sold, there could be maintenance services, there could be support, there could be cloud related services, custom development basis the customer requirement. There could be hardware sale of say servers, networking equipments, or that would all be hardware sale. There could be some training and education related services which could be provided. These are all potential sources of revenue, so as to say. And there would be again sources of expenses as well. So in case there is a product sale, then there would be COGS. Otherwise, generally there would not be any cost of goods sold. Research and development cost would be a significant line item generally in these type of companies. So generally research cost is not capitalized. Development cost, if it meets the accounting standard criteria, only then it is capitalized. So this item is generally critical line item when it comes to IT companies. Depreciation and amortization. Now, if there are a lot of acquired intangible assets, whenever company has done acquisitions in the past, then amortization, its assessment of useful life become extremely important. Employee compensation and benefit. So this would be the single largest, I would say, cost in the P&L account of any IT company. So payroll cost is a very large cost, or I would say a chunk of it comes from the payroll cost when it comes to the expense side. So employee compensation and benefits is extremely critical. Another critical aspect here would be, in case of IT companies, there are various incentive schemes, there are various ESOP schemes which are floated by management to attract and retain the top talent. So accounting of those schemes at times becomes extremely complex. So that is another complexity which we will talk about as an auditor what we should do. But that is an important element which we should keep in mind. Data center and infrastructure cost that could be there, sales and marketing, administrative and interest expense. So in case there are borrowings, there could be some finance cost also attached to it. So this is how generally your sources of revenue and expenses would largely look like. Now, since we have been talking about revenue recognition again and again, that revenue recognition is extremely critical. In case of audit of any company, we all are aware that under the auditing standard, risk of material misstatement due to fraud in case of revenue recognition is a presumed fraud risk. Correct? So it is assumed that there would be a risk of material misstatement in case of revenue recognition. That risk can be rebutted, but there are very specific scenarios in which an auditor would decide to rebut those risks. Otherwise, generally, it's a fraud risk on every engagement. So, similarly, in the case of IT industry, it would be a significant fraud risk on the engagement. Now, let's discuss why we are talking so much about revenue. So, what happens in case of service companies or in case of IT companies, especially wherein Indes becomes applicable? There is a five-step model which a company would have to follow when they assess the quantum of revenue recognition and the timing of revenue recognition. So there are two different aspects. What is the amount at which the revenue is recorded and when the revenue would be recorded? Okay. So basically, if we go through the five-step model, the first and the foremost important step here is identify the contract. So in IT companies, generally, the IT contracts are large contracts, correct? So they are not a simple one-pager contracts. So there are master service agreements which they enter into with their customers, which are generally large agreements wherein there are different conditions mentioned, and then there are statement of work or SOWs which are issued, wherein the scope of services, timing of services, etc. is mentioned. So first of all, the most important thing for an company to do when they do an IT, when they do a assessment of this five-step model is to identify the contract. So as an auditor also, you will need to see which contract they have entered into. What is a contract? Okay. At times the contracts are very complex. There are multiple transactions which are there, which are linked transactions, I would say, which are then governed by one single contract. So because of that, identification of a contract becomes extremely critical. Then the second step comes, which is about separate the performance obligation. So basically, assessment, what is a performance obligation in a particular scope of service and whether those are separate performance obligation or not. So if I have to give you an example, company has sold, say, a license, and then company or a product, and then company would provide the maintenance services over a period of 3 years. Now, sale of a product and maintenance of that product over a period of 3 years are two separate performance obligations, correct? But those could be governed by a same set of contracts. So a contract would be same, which would talk about a sale of a software product and then maintaining that product over a period of time. So these two would be separate performance obligation, and there could be n number of such performance obligations in a particular contract. Next important point is then determination of transaction price. Now, suppose in a contract, as I give you an example, there is a sale of a software product and then there is a support and maintenance which is provided for, say, over a period of 2 years, 3 years. Now, there are no different prices which are mentioned. The price or the amount which is mentioned in the contract is a composite amount. It's a total amount of, say, 5 lakh euros. Now, how will you determine what is the transaction price for each separate performance obligation? Correct? So now we have identified a contract. You have seen that there are two separate performance obligation, but the price which is mentioned in the contract is same. Now you need to decide what would be the transaction price for the each performance obligation. That is when the allocation of transaction price comes into the picture. So first you determine the transaction price and then you allocate that transaction price to different performance obligation. So whatever price is agreed in the contract, that will be bifurcated between different performance obligation, and that involves at times lot of judgment and complexities. So at times it becomes a complex process. It is judgmental as well, and therefore then the amount at which you recognize the revenue becomes extremely important. Now, once you determine the performance obligation, once you look at what is the transaction price which is mentioned in the contract, and then you allocate the transaction price, then the another important aspect is when should the revenue be recorded? Okay, whether it should be an upfront recognition, whether it should be over a period of time, what should be the revenue recognition methodology which should be followed for that particular contract? That is extremely critical. Another important aspect is whenever services are paid on, say, TNMM basis, that is time and material contract. So, suppose an IT company has got a contract where it has deployed its resources, and the rate at which the resources are deployed is fixed. So, the revenue would be recorded over a period of time as and when those services are given. So basically, then deciding how much revenue to recognize every year or every period end becomes extremely critical. Then there could be another set of contract which are milestone based. So suppose there is a contract for a particular development wherein the price is fixed. These are also at times called as fixed price contracts. So the price is fixed and there are milestones which are defined, and those milestones are largely defined more from billing perspective, more from assessing the progress of the project perspective. However, from a revenue recognition perspective, the revenue generally gets recorded over a period of time. So companies use percentage completion method, and then over a period of time the revenue gets recorded. Now whenever such percentage completion methods etc are used, there is again an estimate and judgment involved, because you would determine the percentage basis the total expected total contract cost, which again itself is a estimate which is prepared by management basis their current expectation, and which keeps on getting revised over a period of time. So basically, even in milestone based contracts, that is the fixed price contracts, when revenue is recorded over a period of time, revenue recognition becomes complex because of the estimation which is involved. Another important aspect is at times company do enter into onerous contracts as well because of certain business reasons. So if a company has entered into onerous contract, what is an onerous contract? A contract which would result into a loss for a company, a probable loss which is expected by the company, that loss should be recorded immediately. So those type of contracts, identifying those type of contracts and doing that assessment again is a complex area. Then there could be certain business model wherein the charges are usage based. So per usage based charges would be applied. In that case, then obviously the revenue would be recorded as and when the usage would be done by the customer. Then there would be contracts where upfront revenue recognition may happen. Now, generally, these are very few cases, but suppose there is a license sale where the control itself of that license is transferred, which is perpetual license sale, which is generally a perpetual license. Only in those kind of scenario, generally we can see that there would be an upfront revenue recognition. There could be other scenarios as well, but it depends on the way the contracts are entered into. Hybrid contracts. So what is hybrid contracts? Suppose a single contract has a TNMM element, has a milestone based element as well. So there is a particular development which is fixed, and then there are support services, say, which are provided on time and material basis. So time and manpower supply basis, those are generally hybrid type of contracts. So you will find in a lot of IT companies, especially large IT companies, there are various hybrid contracts, and those hybrid contracts are extremely complicated because there the determination of performance obligation and allocation of transfer of transaction price becomes extremely difficult for a from a company standpoint, and it becomes at times very judgmental as well. So as from an auditor standpoint also, assessing that judgment, challenging that judgment is an extremely important audit consideration which auditor should keep into mind. Another set of companies could be, say, cost plus markup. So in India nowadays, a lot of GCC centers are set up. These are global capacity centers which are set up in India to support the overseas entities or to support the overseas parents at time. So in such scenario, the revenue is recorded on cost plus markup basis. Then there could be a license sale. So a normal license sale, which would say largely would not be, wherein the control would be transferred over a period of time. Then there would be a revenue recognition, which would be recorded over a period of time. There could be subscription based services. For example, generally we nowadays use a lot of OTT channels, etc., wherein it is all subscription based. So in case of subscription based, again it would be basis the subscription period based which the charge would be levied on the customer, or the revenue would be recognized in the books of the company. So from a revenue recognition standpoint, the most important consideration which you should keep in mind is this 5-step model. Go through the contract, see what is the type of contract. Generally, you will find that the contract will fall into one of these categories, and then assess when should revenue be recognized and at what price. That is extremely important. Now, before we move ahead, let's look at certain important audit procedures which we should do in revenue recognition. So when we do audit procedures, first of all, we will do our control testing, right? We will do the understanding of the entire revenue recognition process. We will test key controls in that particular process, and then we will move to substantive procedures. Now, since revenue recognition is a fraud risk, we will have to do the walkthroughs in revenue process, even if we decide not to test on controls in case ICFR reporting is not applicable. But generally, if you are doing a decent sized company where ICFR reporting would be applicable, you will have to also go through the controls, which will give you a good level of assurance, or which will show you what could be the potential areas of material misstatement, and then basis that you can design your substantive procedures. But if we have to talk about generally what should be the substantive procedures, so the most important thing is, um, go through the list of contracts which the company has entered into with various customers. So that is extremely important, whether there is a list of contracts which the company has maintained with its customers. Then for certain contracts, you need to understand the key terms of the contracts. Now, as I generally said, these contracts are extremely large contracts. So they are generally in the form of master service agreement or statement of works. So master service agreement are master agreements which run into n number of pages, and SOWs would be 1 or 2 pager document which largely covers the timing, the delivery time frame, the scope of the arrangement. So you need to go through these agreements on a test check basis, or whatever samples you would have decided in case the quantum is very high. Then identify the model of revenue. So basis reading those contracts, you would understand whether it is transaction based, whether it is subscription based, what is the type of service which is provided, whether it is per user based, whether it is multi-year contract, whether it's a 1 year contract, what is the time frame. All those aspects you will be able to identify only when you go through those revenue contracts. Another important point is, again, then see what is the assessment which management has done. So whether management has done the 5-step assessment, identified all the performance obligations within the contract. If yes, then whether there is a transaction price defined for those in the contract, or whether they have done the allocation of transaction price. So at times, in case of contracts, different transaction price could be defined for different services. So there you can then assess those transaction price and recognize revenue accordingly. In case there are no transaction price which are bifurcated, then there could be a scenario where you will need to do that detailed assessment, and then the management will allocate the transaction price, which you need to verify whether that allocation has been done appropriately, or what is the methodology used to allocate that. Okay. Another important aspect is, generally in India, you will find there are a lot of contracts which are time and usage based. Correct? TNMM contract, where there is a supply of manpower which is given to do the product development or to do the whatever services are required at customer end. These are built on time and usage basis. So in such type of contracts, whenever there is an accrual which takes place at a period end, generally try and see the trend of the accrual, whether that is almost in line with what was accounted for in the past month, and whether customer confirmations are obtained. So a lot of companies, what they do before they bill, as a process, they have to send the employee timesheets to the management and to the customer, and get those approved from the customer, and post which billing takes place. So whether the customer approvals are obtained, that is another way to look at it. Some companies don't maintain, or some customers don't mandate that. So in those cases, you can look at the past trend, and whether there have been scenarios where revenue was recorded which was further reversed because the amount could not be received from the customer. So all that assessment also needs to be done. Another important audit consideration would be in case of fixed price contracts. So in case of fixed price contracts, what happens is company would have to use the input method to compute the percentage completion basis which the revenue would be recorded. So whenever percentage completion assessment is there, you will have to assess the controls which the management or the company has around computing the project cost. You need to validate those. You will need to also look at those calculations basis which the revenue is recorded, and also the milestones which are defined in the contract. In such scenarios also, generally the as and when the milestone is achieved, customer approvals are taken. So here for approval, you may not have a scenario where the customer approval would be there, but on milestone billings are raised or not, that can be assessed. Plus, you can also see a trend whether these unbilled revenues which are recorded. So whatever accrual will take place at period end, that would be an unbilled revenue. As and when it is billed, what is the time frame in which it is billed? That is generally contractually governed or not, and whenever it is billed, whether that is collected or not. So basically, it would not be only a particular contract. You will also have to do a lot of analysis of past trend. You will have to see what is the history with a particular customer, whether you could see reversals of past coming in the current year. That would give you further, I would say, further idea whether the revenue recognition mechanism followed by management seems to be appropriate or not. If you have sufficient period after year end, you can also see the subsequent billings if that would have already happened. So these would be few key revenue recognition related procedures which you should perform. Now let's move to other areas. As we spoke about, like intangible asset is another important area. So suppose if a company has incurred software development cost, and company is capitalizing that as an intangible asset, the most important aspect is to review whether the capitalization criteria has been met or not. So the Ind AS has a detailed criteria which is given, wherein only if those criteria are met, only then a cost can be capitalized. If those criteria are met, then you can do an assessment and review that the capitalization is done and an appropriate period, appropriate cost is capitalized, and you can see the future economic benefits which would come out of it, etc. So all that assessment becomes extremely critical wherever there is a capitalization of software development cost. Also keep in mind, whenever you are doing a review of capitalization, whether you are taking a decision whether a cost should be capitalized or not, you should also take into account what is the type of software, what is the expected cash flow which is expected out of it. Because see, in IT industry, the technology is developing at a, or I would say it is changing at a very faster pace. So you should be, or management should be very clear that the cost which they are capitalizing meets the standard requirements. So that review has to be in detail whenever you do a capitalization of cost related review in IT company. Then look at the amortization related method. What is the method used for amortization? What is the life which is used? And whenever the life used, consider the technological obsolescence aspect as well in determination of useful life. So that is another important thing. So let's move to the other aspect, which is payroll cost. Now, since payroll being a very significant cost in the P&L of an IT company, a lot of audit procedures should be performed on the this particular cost. So the most important thing is performing a test of controls on payroll cost. So once you perform a test of controls, then you have to perform substantive audit procedures. So where you can look at the employee masters, you can verify the samples on test check basis, you can trace the salary payments, you can perform various analytical procedures. The most important aspect wherein I would like to draw attention would be on the employee stock option related schemes. So what happens is, in case of these companies, to retain the top talent, a lot of ESOP schemes, and at times those schemes are really complex, or share-based payment schemes are floated by company. Now, whenever such schemes are there, whether those are board approved, whether there is a proper policy in place, and what is the accounting implication of that scheme, that is extremely important. So whenever these schemes are there, there is a need of valuation to be done. So you also would need to At times, if the amounts are material enough, you may also have to involve your valuation specialist within the firm to assess and to see whether the valuation methodology which is adopted is appropriate or not. Plus, you will also have to look at the assumptions which a valuer would have considered. Correct? So, whenever you are auditing IT company wherein there are ESOPs schemes, please keep this in mind. In case of IT, in case of startups, you will come across a scenario, especially when in case of startups which are very small. A lot of startups have these ESOP schemes, but they are not much aware about the accounting implication. So even at times it happens that the even auditor is not aware that company would have given any ESOP. They would not have passed proper resolutions. They would have issued the letters to employees. So every startup company, whenever you are auditing, make it a point that you discuss with the management whether they have issued any ESOPs, because there the compliance generally in a very early stage startups is not very high, and there we tend to miss out on accounting for this. So these schemes become extremely relevant from an accounting perspective there as well. So please keep that in mind. Another important aspect is regarding the actuarial valuation. So whenever you're auditing that area, whatever long-term employee benefits are there, whether the data sent to actuary is appropriate or not, you also need to challenge the reasonableness of the assumptions which are used by actuary, especially the increment rate related data which is used by the actuary. All those aspects need to be looked into, or all those assumption needs to be looked at, needs to be backed by sufficient explanation from management, which you should be satisfied as an auditor that those assumption looks appropriate. So that is another important aspect. Now, coming to next point, I think intangible we already touched upon, but one more aspect which I would like to cover here is regarding software capitalization and development cost is the impairment part of it. So the impairment testing of this has to be done at least annually by comparing the carrying value to recoverable amount. So impairment assessment has to be done annually in case there are any triggers, and we will talk a lot about triggers in the coming slides, because there could be a number of triggers in a company basis which you would decide that you would want to do a detailed impairment assessment. An impairment assessment again is a complex process wherein the cash flows are plotted, those are discounted, and then we do a comparison of the carrying amount to the recoverable value. Whenever you do that, you will also have to assess the involvement of the specialist, the valuation specialist, whenever a detailed impairment assessment is performed by management, or whenever you believe that the impairment assessment is extremely critical or it's a risk of material misstatement on that particular client, you should involve your specialist or experts. Another important area would be provision for tax. So generally, whenever there is in an IT company, there is a setup of a parent and a subsidiary situated overseas, we may need to involve the transfer pricing experts. So management will involve their transfer pricing experts to determine the arm's length price, because there would be transfer of services. So generally, the way a lot of companies do is India is considered as a service delivery center, wherein employees, generally large chunk of employees are based out of India. They provide the services, whereas the contracts are entered into by the overseas entities, because those are the entities who front end the sales part of it. They enter into the contract and they back to back, I would say, offload it or outsource it to the Indian entity, and then Indian entity provide the services. Now, not necessarily every company will have that model, but a lot of companies I have seen have that kind of a model. So, in those scenarios, a transfer pricing arrangement becomes extremely important. At what margin would be retained in a particular country, what margin would be brought into India, that's a complex aspect. So, consider evaluation of a transfer pricing expert, involvement of a transfer pricing expert to do an evaluation of management's assessment over this. It also depends upon whether the entity also has a lot of transfer pricing litigation, etc. So if it's a settled principle, not much challenge, litigations are not there, your comfort level as an auditor may be a bit higher. But in case of a new setup where things are to be decided for the first time, there the involvement may be required, or where there are a lot of transfer pricing litigations which are going on with the authorities, there also you may want to make sure that you involve the experts who can look at the transfer pricing related aspect. Another important consideration could be there would be certain tax holiday period wherein certain benefits would be availed by these entities. So earlier there were a lot of SEZ benefits which were there for the IT company wherever there was a and there was a tax holiday period. So if those tax holiday period is not over, whether the deduction claimed is appropriate or not, whether entity is complying with those tax holiday related norms. Another important aspect is basically such entities do an assessment of new tax regime versus old tax regime. So whether they have the benefit to continue with the tax holiday, whether they have done an assessment to assess whether it is better to continue with tax holiday or it is better to move to the new regime. That assessment is extremely important so that whether the entity has done that and whether they have taken that into account is another important aspect. Whenever there are various litigations, whether the company has taken appropriate opinions from tax consultant to assess the possible outcome of those litigations. Whenever they take those opinions and they believe that they have a good chance of winning that matter, or those matters are disclosed as contingent in nature, we also need to involve the experts as an auditor and evaluate whether the legal opinion taken seems to be appropriate or not, or whether we believe that there could be further any further potential risk or any uncertain tax position coming out of it. So that becomes extremely critical. Disclosure requirements obviously is there. Other than that, in case of a group wherein the subsidiaries are there overseas, and you will find a lot of IT companies doing the entire accounting from India. So there they would be managing the books of accounts also from here. If you're looking at the subsidiaries tax provisions, you may have to take the help of the experts of those particular country who can help you whether the tax provisions are appropriate or not. So even their involvement of tax specialists may be required. So that also should be factored in basis the presence or the basis of the structure of the company. Another important area is business acquisition. So generally, as I mentioned, most of the IT companies they grow by acquiring other IT companies, and therefore there is an inherent risk associated with the big business acquisition. Now, what happens is business acquisition per se is a complex transaction, plus the accounting which is prescribed under Ind AS 103 is also a bit complicated, I would say, is also important. And therefore, it is very important that whenever there is a business acquisition which is done, as an auditor, you also need to evaluate whether it's a business or it's an asset acquisition and then see whether the accounting treatment is in line with Ind AS 103. Because generally, in IT company, it would be a business acquisition because they would be acquiring the, I would say, customers, they would be acquiring the manpower, etc. So, from that standpoint, whether the accounting treatment which is done that is as per Ind AS 103 or not is important. Once the acquisition is done, then as per Ind AS 103, there has to be a purchase price allocation. So that purchase price allocation, the fair valuation assessment, which is done by the experts or the valuer of the company, that also there also you need to assess the involvement of an expert. So basically, you should involve an expert there to assess whether the purchase price allocation methodology adopted is appropriate or not. Plus, in the process, at times there are a lot of intangible assets which gets recorded. So what happens is one is fair valuation of assets and liabilities. In IT companies, generally there are a lot of intangible assets and liabilities which gets acquired. So say customer contracts, that becomes your asset. There are patents, etc. So whether the value which is allocated to them is appropriate or not, and whether the goodwill which is arrived at, because then the goodwill becomes a balancing number. So that entire review of the purchase price allocation methodology is extremely critical. Another aspect is what is the life which is assist or which is allocated, or I would say the life which is determined for these intangible assets which are acquired. So, say suppose if customer contracts is identified as a separate intangible asset, or say patent is identified, then what is the life which is determined or life which is allocated to that particular intangible asset is another important consideration which we need to take into account. So you need to also compare whether the life which is mentioned there, whether there would be benefits arising out of that asset over that particular period which is being determined. What is the life which generally industry is using. All those aspects are very, very important because uh, as and when there are triggers, then you need to test them for impairment, and goodwill any which ways has to be tested for impairment annually. So from that standpoint, this review of purchase price allocation methodology is extremely critical, and the compliance with Ind AS 103 is very, very important. So whenever there is a business combination, please involve the required experts. Another important area in the balance sheet of an IT company would be around unbilled revenue. So what happens is largely in case of IT companies, wherever the revenue is recorded over a period of time, I would say fixed price contract, there could be a portion of unbilled revenue which would be significant. And then the unbilled revenue would be carried in the balance sheet. And therefore, it is very important to review what is the number of days unbilled revenue which a company is carrying in its books of accounts, whether it is backed by signed SOWs or not, or signed contracts or not. Look at the trend which company is carrying for the outstanding unbilled revenue, whether there has been an increase, significant increase. If that significant increase is there, then you need to corroborate the reasons. You need to review the unbilled revenue policy which company would have formed for itself. Otherwise, then there is a lot of discussion and debate around reversal of the unbilled revenue. So therefore, unbilled revenue is an extremely important area, and therefore, if there is a significant chunk of it lying in the balance sheet, the audit procedures have to be, I would say, quite detailed here to assess and see that the revenue is appropriately recorded. Now, let's come to some other important areas. We spoke about goodwill, right? That whenever there's an acquisition which takes place, there is a goodwill which gets recorded. Generally, you will find that a goodwill which will get recorded in the books of accounts. So, what is a goodwill? Any excess of the purchase price over the fair value of identifiable assets and liabilities. Okay, so it includes both tangible and intangible assets. So, whatever is the excess of the purchase price over the fair value, that is recognized as a goodwill in the books of accounts. So if you look at the example of a large IT company, they acquire a smaller software development firm for 100 million. The fair value of acquired assets and liabilities was 70, and therefore the remaining represents a goodwill on the acquiring company's balance sheet. Now, as per the accounting standard, this goodwill is subject to annual impairment testing when the company assesses if the carrying amount of goodwill exceeds its recoverable value. Okay. So basically, once you record this goodwill, every year you will have to review the impairment assessment which is performed by management. Impairment assessment itself is a large activity requiring a lot of, I would say, which requires a lot of judgment, etc., to be exercised. Therefore, whenever there is a goodwill getting recognized, that purchase price allocation, get the experts involved, and then every year, whenever there is a goodwill which is getting tested for impairment, if you believe that there could be a scenario of impairment analysis, that means the gap between the carrying value and the recoverable value is not very high, you can also decide to involve the experts. So if it is possible, it is always better to involve the experts here because these are the areas which are very, very judgmental in nature. Okay. Now let's look at what are the triggers which may tell you that there could be an impairment. So take an example of an acquisition. So one we spoke about goodwill and one is about other IT assets. So whenever there's an acquisition which takes place, there would be certain tangible assets, there would be certain intangible assets, correct? And then the balancing would be goodwill. Now, let's look at what would be the trigger basis which you may decide that there has to be an impairment loss which should be recorded. So for goodwill, annually you have to do impairment. For impairment of other IT assets, the company may need to assess whether the carrying amount including any development cost, exceeds the recoverable value. If it exceeds the recoverable value, then it is okay. If it is lower, then an impairment loss must be recognized. Okay. Now, Let's quickly look at what are the impairment indicators. Now, market decline. Suppose there is a downturn in the technology sector, there is a decreased demand. Now, when I say technology sector, the particular technology which a company would have acquired, or the particular technology for which company would have done the capitalization. Now, there is no much demand for that. Okay, that there has been, the technology is almost becoming obsolete, or there is shift in demand. Okay, there's a lot of competition. Company is not able to get a lot of customers, or there is a loss of market share. Customers have decided to move to a particular player, or the technology itself is not there in demand. That would all constitute a market decline. So, if there are indicators of market decline, you should check it for impairment. Technological obsolescence, obviously outdated or rapid technological advancement may result into this. Then again, you will have that would be an indicator for impairment. Loss of key contracts or customers. Sometimes what happens is whenever these, especially whenever these companies acquire small IT companies, these small IT companies they acquire for specific customers. These small IT companies may be serving few good customers, or the technology may be niche. So whenever there is they are serving certain few customers for which that acquisition takes place, then generally there is a lot of dependency on those customers, because those would be say top 5, top 10 customers, which would constitute largely 80-90% of the business. And then there is a loss of those contracts with these key customers. The customer decide not to renew the contract. In those scenario, when there is a dependency on a major customer and those contracts are lost, okay, then there is a impairment indicator. You may have to look at the customer contract related intangible, which could have been recorded as an intangible asset. You may also have a scenario that your future cash flows definitely will get impacted because of this, and then there could be a goodwill impairment as well coming out of it. So loss of key contract or customer is a very, very big indicator, especially in case of dependency on few of those. Regulatory changes. So in case there are new regulations that could impact the product, or that could increase the compliance cost, or that could result into any implication, then all those things should be also considered as triggers for impairment. Technological disruption, correct? Because of the I would say emergence of disruptive technologies, this could happen. There is an economic uncertainty. So there is a change in interest rate, very high inflation rate. This could also result into your change in assumptions, resulting into impairment being recorded. Currency fluctuation also could result into it, because as we saw, they generally have geographical presence. So if there is a big currency fluctuation which comes up, there would be certain losses, okay, which may arise. So all that also needs to be assessed. Internal issues, obviously that would be there. Any internal governance related issues, or any management related issues, any operational inefficiencies, underperformance of acquired businesses. Many times it happens that whenever a business is acquired, there's an expectation of X number coming from that business, but that business is not able to perform the way it was expected. Again, that would be a very big indicator, and that may result into your goodwill impairment, correct? Because you would have paid an X price basis your expectation, but that expectation is not getting fulfilled. So then the impairment may need to be recorded for the goodwill. Another important aspect in any audit is whether there are triggers for going concern. Now, since we saw for impairment of goodwill, that in case there is goodwill or there are intangible assets, what could be the triggers? Similarly, as an auditor, for any company, you need to assess whether the going concern assumption is valid or not. Now, at times, there could be certain events or certain triggers because of which there could be red flags, which you as an auditor should look into whether there is a problem with going concern assumption or not. For example, say take market demand and competitive dynamics. So there could be decline of a particular product because of a new product which is launched. Say earlier, a lot of people used to go to theaters for movie. Now, because of OTT platform, there has been a scenario that people prefer the OTT platform. Now it's a shift in market, correct? It's a shift in the demand, shift in dynamics. such scenario may result at times into going concern. So take an example that company is predominantly into one particular technology. That technology itself is becoming obsolete. Okay, or people are not preferring that technology because of newer technology. So that is a trigger for going concern. There are financial performance challenges. So there is a loss, there is a declining profitability, there is no sufficient cash flow which is getting generated. There are liquidity related issue. Correct. You also have to look at current asset minus current liability related scenario. So all those could be triggers for going concern. So technological disruption, which we spoke about, say the technology which the company is currently dealing into has become completely obsolete, and new technology company is not able to embrace. So company may have invested to deploy or to use the new technology, but they are not successful in that. So that could be another issue. Then legal and regulatory issues which could arise. That would be another issue because of which there could be trigger for going concern. There could be certain operational risk as well because of which going concern could be there. So a lot of attacks being faced by the company, which has resulted into a huge loss of key customer to the company. So say company has a huge dependence only on one customer, and that has been lost because of certain such issues. There would be a trigger or there would be a need to then assess the going concern assumption. Correct. Strategic challenges, correct, which would analyze lack of innovation, very high turnover ratio in key management, lot of changes in the senior management. Again, there could be a trigger for going concern. Important economic factors. So company has say a lot of business in one particular geography, and that market is doing extremely bad. There are a lot of economic upheavals in that market. There is a lot of interest rate related issues in that particular market, or high inflation. That could be another trigger. Capital structure and financing challenges. So this could be all liquidity related challenges, etc. Too much reliance on debt. All those would be the challenges which may result into a trigger for going concern. So largely till now, what we tried to cover was what is the business generally of an IT company, and what are the key risks which are generally associated when you audit the, or key considerations which are generally associated whenever you audit any IT company. So we spoke about that. Now, other than the risks which we spoke about, so when we spoke about risk, we spoke about it more from a financial statement standpoint, the risk which may impact the financial statements. But there would be other risks also which may be associated with these companies, and those could be talent retention. Now talent retention, I would say, is not very specific only to IT. It is generally there with every sector, but IT being a service company wherein the employee itself is the asset for the company to deliver the services, talent retention programs, etc., becomes very critical. So this could be one of the, I would not say audit risk, but yeah, definitely business risk. From an IT standpoint, very high attrition. So after 2020, we all would recollect that there was a great resignation era which had happened across the sectors, especially the IT companies, wherein the employees resigned, moved to other companies. There was very high attrition, which every company was facing into. I mean, at times the attrition was even more than 20-25%. So these then somewhere lead to a risk which is there, which is impacting the business of the company. So talent retention and high attrition are two important risks. Other than that, evolving technology. So the sector itself is such that disruptive technologies will keep on coming. So evolution, I would say, the agility of the company to quickly embrace it, innovate, learn, quickly turn around. All these capabilities are any which was required in any IT company from a business standpoint to be successful. So evolving technology would be another risk. Currency fluctuation. Now this is extremely important whenever there are companies which operate in various geographies, and there are I would say a lot of fluctuation which happens in the currency. over a very short period of time, this again becomes a very big risk which is associated. So generally what companies do, at least large ones, they try to hedge this risk. So many companies take forward contracts or they take option contracts to hedge the risk which is arising out of it. Now, those contracts have its own, I would say, nuances attached to it when it comes to the hedging part of it or the accounting part of it. The accounting for those contracts is also complicated. So, whenever any of your IT companies have currency fluctuation related aspect for which they have taken into forward contracts, again, there you need to be very careful, ensure the compliance with the IND-AS 109 financial instrument standard and see whether the accounting for those contracts is done appropriately or not. Another risk could be compliance with various laws and regulation. So this we already spoke about that they need to make sure that in what all geographies they are there, all laws and regulations are largely complied with. Say for example, in case of US, there are a lot of laws related to payroll, correct? So all those are complied with or not. And what are the processes here? It is very important to understand management process in place to ensure this compliance because a lot of companies should first have a process in place wherever they are operating in multiple geographies and only then you will be able to assess that process as a auditor and place reliance on that process, correct? So understanding of this process which management has implemented is extremely critical. They should get in each location, they should get these review for laws and regulations etc done on a periodic basis to ensure they comply with it. Data integrity and cyber security related risks. So I think data integrity, cyber security again are very, very important from a business standpoint as well. Data integrity from a customer standpoint is extremely critical. So that is a risk associated with the company. Cyber security, again, nowadays the cyber attacks have increased significantly. Cyber scams and attacks have resulted into a lot of losses to different companies. So cyber security related risk, how management is mitigating that risk or how management is, what steps management is taking to mitigate that risk. That is very, very important. So suppose if you are auditing any listed company, if you have to look at the different risks which the company has assessed, so their risk register would be a very good starting point. Even the annual report covers a lot of different risks which a company presumes or which a company perceives in its business. So if you go through any IT company's annual report, you will come to know largely they would be talking about these type of risks which the company perceives it would have. And then what are the steps which that company is taking to mitigate those? So those are generally your starting point to assess what all risk a sector or a company would be facing, and then you would assess it into business risk and audit risk because not every business risk would result into a audit risk. So from that standpoint, you also need to do a detailed assessment whether it is a business risk or whether it is a audit risk. Correct? Now let's move to next part on IT general controls. Now why IT general controls is so important? So what happens is wherever companies are using complex ERP tools or company has systems like SAP, Oracle, there a lot of things are done automated. Okay, so a lot of processing is done on an on a click of a button. So there, testing your manual controls may not be able to give you the required level of comfort. And that's where you need to understand the IT environment, which is a complex IT environment for that entity, and then start testing the controls to see whether that environment is effective or not. Okay. So first, when you do the understanding, that time only you need to take the understanding of what all IT systems company is using. Once you take that understanding and there are complex ERPs which are involved, company has automated a lot of stuff, then you will have to involve your IT specialist. Now that IT specialist will do two types of testing. One would be the IT general controls and second would be the IT ITAX or the IT transaction level controls. Okay, now IT general level controls is kind of a testing of an overall IT environment wherein they would look at whether the user access which is provided is appropriate or not, whether there is a user access granting related policy, whether that policy is appropriately reviewed, whether there is a change management is another aspect. So whether any changes which are made to the system are authorized or not, whether they are tested sufficiently prior to implementation or not. Then there is another aspect on IT infrastructure, whether there is a system backup which is taken regularly or not. Company has a data center which is designed to prevent itself from damages or not. Whether there are any unauthorized changes which could be made to the system. All these aspects are covered as part of IT general control. Once these IT general controls are operating effectively, then there could be certain transaction level controls. For example, whenever an employee fills a timesheet and it gets approved, there is a cost which gets recorded against a particular project cost, basis which a project profitability can be monitored. Now, this is an automated control. These controls are required to be tested only through using the systems in place. So those transaction level controls can be tested once these IT general controls are concluded to be effective. Another important aspect is now considering the requirement of reporting on audit trail as well. IT plays a very major role, especially when it comes to the log maintenance of log and then backup of those particular logs. So that for that also you will have to involve your IT specialist to understand whether the company has done that in a complex type of ERP. So IT general controls and auditor should test the ITGCs and to ensure that they are designed and operating effectively. That will give you a lot of comfort on the control environment of the IT of the company, basis which you can plan your substantive procedures. Now let's come to the documentation. So it is as always said that in case it is not documented, it is not done. So from an audit documentation perspective, if you're auditing any company, what is the bare minimum which you should have? So you should mention the scope, your purpose of work paper, with what are the procedures which are performed and the conclusion in every work paper which is prepared. Okay. So basically, what does the work paper cover? Who has prepared it? Who has reviewed it? What are the procedures performed? What was the conclusion reached? Which are the samples which are tested? All that has to be a part of the audit documentation. Please keep the client related data separately and the audit procedures performed separately. Client related data is not your audit documentation. What are the key aspects which should be documented? So one is understanding of the entity and its environment. Okay, so we saw that before you start any risk assessment for any audit, even from an auditing standard standpoint, first you need to understand the business. So there has to be a detailed documentation of the understanding of the entity and its environment. Once you do that understanding, then there has to be a detailed risk assessment procedures performed for each FSA. And then you need to identify the risk clearly into what is significant risk, what is high, why you believe a particular risk is a significant risk or an elevated risk. All that needs to be clearly identified and documented. Okay. Once you identify the risk, then there has to be entities processes related to each significant cycle. Then once you identify what all processes are there, then the walkthroughs have to be performed for the entire process for the identified risks. And basis the performance of walkthrough, then we have to do the control testing for all the key controls. Supporting document supporting the understanding of ITGC also is a very important document which needs to be included in your audit work paper. Materiality computation, that is again we saw how materiality should be determined. So basis of materiality
ये है क्रैक्स
computation, rationale
बिगीज
for that also should be documented. All the working papers basis which the in which the audit procedures are performed, those should be at the end tallied with the financial statements. Agreement of major customers who contribute a large chunk to the revenue portion, or the agreements which are tested as a part of your work paper when you are testing the revenue related aspect. All those agreements or the synopsis of those agreements, if those agreements are very bulky, the synopsis of those agreements should form part of your work paper. Any legal opinion taken, any tax related aspects, wherever there is an opinion taken from consultant, that also should be there. Related party related documentation. identification of related party, ensuring its completeness, looking at the arm's length assessment, that should be a part of your documentation. Working of tax experts, involvement of tax specialist, evaluation specialist, all that is very, very critical. In addition to that, engagement letter, signed management representation letter, all should be part of your, both the documents should be part of your audit engagement file. So this is not a comprehensive list, but these are the key items which you should focus on when when compiling your audit file. Now, since we saw what are the key risks which are there in the sector, what are the key considerations which are there in the sector, I thought it would be good if we also could look at the key audit matters. So, which the companies, different IT companies have in their financial statement, wherein their auditors have included certain matters as key audit matters. So, the idea here is to give you a glimpse of generally what are the type of areas, okay, where which the auditors have highlighted as key audit matters in large IT companies. So you will find that whatever matters we will discuss now would be largely covered into whatever risks we spoke or whatever areas we discussed during the first half, because those are the critical areas for even these large IT companies. So revenue recognition, if you see the fixed price contracts where revenue is recognized using percentage of completion method. So we spoke about revenue recognition and fixed price contracts. So generally, if you pick up any large IT company, you will find there is a CAM on the fixed price contract where revenue recognition happens based on percentage of completion method. Now, if we have to understand why, as I already told you that the revenue recognition of fixed price contracts generally is comparatively complex. There is a judgment involved there. Uh, the determination of the total contract cost itself is a management estimate, correct, which is complex at times, and therefore that is considered as a judgmental area and key audit matter. So if I have to quickly read out the reason why the auditor or the description of the key audit matter for this is the group engages in fixed price contract where revenue is recognized using percentage of completion computed as per input method based on group's estimate of contract cost. So we identified revenue recognition of fixed price contract where the percentage of completion is used as a key audit matter, since there is an inherent risk and presumed fraud risk around the accuracy and existence of revenue recognized, considering the customized and complex nature of these contracts. So look at the language, the customized and complex nature of the contract and significant input of IT system. So some time back we were talking about the importance of ITGC. So the reason why auditor has considered this as a CAM is basically the complex nature of the contract, and there are significant inputs to IT system basis which these calculations are made. So this is a complex activity and involves a number of key judgment and estimates in mainly identifying performance obligation, related transaction price, estimating the future cost to completion of the contract, which is used to determine the percentage of completion of the relevance performance obligation. These contracts may involve onerous obligations, which requires critical assessment of foreseeable losses made by the group, and at the year end, significant amount of work in progress is there related to these contracts are recognized in the balance sheet. So basically, they are saying one is the complexity of the contract. There are significant inputs to the IT system. Plus, these because these are complex, this requires judgment. In identifying performance obligation and related transaction price, in estimating the future cost of completion, and in estimation of onerous obligation. So all these aspects they have considered when they have determined this as a key audit matter. And if you look at broadly, what are the audit procedures performed? The auditor has involved the IT specialist who has tested these complex IT systems. And then auditor has also tested these key controls around the allocation of resources, budgeting system, authorization of cost, etc. And then they have, if you look at the procedures which they have performed on the revenue, they have looked at the identification of performance obligation, transaction price, and then they have tested the computation of the estimation of cost and onerous obligation. So wherever management has done a computation of estimation of contract cost, they have tested those basis certain procedures, and they have also looked at the onerous obligation. So this was a key audit matter regarding revenue. Now let's look at another key audit matter. Again, here also the key audit matter is regarding the fixed price contract only. This is regarding, if I name the company, it's about Wipro's March 24 annual report. So here again, revenue from fixed price contract, including software development, is considered as a key audit method. Even if you go through this entire thing, the crux is because there's a lot of estimation involved here, and revenue being a fraud risk, the risk of estimation uncertainty is very high, and therefore this is considered as a key audit matter. Now let's look at some other company, Persistent. So in Persistent also there was a cap on revenue related aspect, that is revenue of fixed price contract. Other than that, there was a cam on impairment of goodwill. As I told you, if a company would have done a lot of acquisitions, impairment assessment of goodwill becomes extremely important. So in this company, they would have done acquisitions wherein the auditor has said that the group's asset include goodwill to the tune of 10,912 million INR related to business acquisition made by the group, because of which the determination of the recoverable value of CGU requires a lot of judgment from management perspective. And considering the judgment involved, there are a lot of key assumptions which are there, and the balance is very significant. This is considered as a key audit matter. So, whenever there is a goodwill which is lying on the balance sheet, which is very significant to the balance sheet size, whenever you are doing an impairment testing, there would be definitely a lot of assumptions which would go into that impairment assessment. So that would be considered as a key audit matter. Now quickly look at the procedures which a auditor has performed. So auditor has honestly looked at the controls around this process, and they have tested the projections which are used to do this assessment. So testing of projections is extremely important. Whenever there is any impairment assessment is done, the most important thing is the projections which are used, the underlying projections which are used. Now testing of projections is very judgmental. You have to look at the past performance. You have to look at the assumptions which management have considered. You have to look at why they believe those numbers could be achieved, whether they have any certainty on those numbers or any orders in hand currently against those numbers which are lying with them. Then there has to be a detailed sensitivity analysis which should be performed. So whatever assumptions are key assumptions which would lead into change in the value, there has to be some sensitivity performed. Say if 1% of change in that assumption or 2% of change in that assumption, what would be the impact on the overall recoverable value of that particular CGU? That sensitivity has to be there, and see whether the headroom is sufficient or not. So at times it could be a very borderline case, and any 1% change would also result into an impairment. So that would be an extremely sensitive case, and therefore the risk would be very high there. So therefore, it is very important that there has to be a sensitivity analysis of key assumption, and this item should also be discussed with those charged with governance. And then look at the disclosures, etc. So we saw revenue being there. We saw impairment assessment of goodwill. Last one more example which I would like to cover is on valuation of ESOP. As I told you, a lot of IT companies have these ESOP plans. A lot of plans may be routine in nature, but there could be at times the plans which are very complex, or the value which is involved, or the I would say the judgment which is involved in valuation of this would be very high, and because of this the auditor would have considered this as a key audit matter. So here again, understanding of that plan, testing the controls around it, looking at the data. Here the most important aspect is involving the valuation expert. See, in case of impairment of goodwill, and here evaluation of experts in valuation expert involvement is extremely critical, because there are certain technical methods basis which these valuations are carried out, which we as an auditor may not be able to completely understand. So obviously in case of impairment assessment, future projection, etc., will be tested by the audit team, but the valuation expert would be required to assess the valuation related assumptions which are considered. Correct? What is the percentage of discounting which is applied? what is the beta factor which is taken into consideration. For all that, you need a valuation specialist. In case of ESOP, if suppose say Black and Scholes methodology is used, then what are the various assumptions which are considered by the valuer there? Whether those seems to be appropriate or not, the valuation methodology also seems to be appropriate or not. For that, you need to have a valuation expert. So always keep in mind, wherever there are experts used by management to do any assessment. Generally, in IT companies, you will find two type of experts. I would say rather say three type of experts. One is valuation expert, one would be actuary, and another one could be around the tax experts for all the litigations related matter. If any such experts are used, you should also involve your experts to validate those. Don't rely directly blindly on management expert. You need to challenge the assessment which is done by that expert and to mitigate your risk and to be comfortable that whatever is done appropriately. Plus, the another important aspect which should be considered is what is the competency of management expert who has been employed. Okay. So the competency element of your as well as management expert is extremely important. So whenever management is deploying any valuer, whether he is experienced in these matters, whether he is a registered valuer or not, what all assumption, I mean, what all experience he has in dealing with such type of IT companies, all that will be very, very important. That should be forming part of your documentation. So this brings us largely to the end of our today's discussion. I would be happy to take questions if any.
Hi, Shraddha. It was a very informative, very educational, very detailed, I would say. You've covered, am I audible?
Yeah, yeah,
Yeah, you have covered, a lot of critical aspects, which are required for performing an audit, right from the design, the structure, the operational controls, and everything you've covered very diligently. And the presentation was also very nice. My question, some questions got answered. I was thinking of picking up some questions, and you were answering them in between. But
okay.
yes, definitely one question and maybe few some which I can ask, and maybe you'll have to maybe repeat. When you do an audit of law, as you mentioned about the startups, so I would like to know more about the startups audit that you conduct, because the startups are definitely are a very critical part of the IT sector right now. And definitely I'm sure when you perform an audit of that kind of sector versus the company which is listed, unlisted, those which are established companies, the risk and the profile and the approach to an audit completely changes. The mindset, as you were mentioning, that they don't know much and probably they need help on the board resolution, smaller nuances when you're conducting. Can you throw more light upon, because I am sure people would like to know more
Yeah,
how your approach has been there while you conduct a startup versus an established company?
yeah.
Thanks.
So, Pooja, I think rightly pointed out the approach for a listed company would be very, very different because that would be more of a, I would say, entity which has a lot of structure, etc., in place, good controls in place, vis-a-vis a startup, especially the startup which is not very matured enough, which is still in its early days. I think that startup, those type of startups, they don't have required, I would say, competent staff along with them who can guide them when it comes to such policies. So there I would say the approach has to be when it comes to startups, laws and regulations is an area, or I would say finance is an area which is bit neglected by the startups, especially the early stage startups, till the time they move into that phase where they get those series A, series B funding, and then they are a bit serious with the investors or the I would say the listing part of it. Till that time, yes, there is a lot of laxity, or I would say the business focus is much there. Cost is also a constraint. The most important thing as an auditor, you need to make sure that you communicate the importance of compliance with laws and regulation with management. You suggest them to have good control around at least compliance aspect, because these, if there are a lot of non-compliances, it goes into a long way in their startup journey also, as and when they move into the fundraising aspect, etc. So these compliances may turn out to be very difficult to handle after a particular point in time. I have seen companies burning a lot of money because of that. So I think that is very important aspect. Second, if you are dealing with IT related startups, the revenue model assessment is very, very important because see, generally startups, everything is dependent on revenue. Correct? Their valuations are also dependent on revenue, and the model could be at times very, very complex. The new age startups are very tech companies, wherein you may not have seen those type of companies in detail. But if you go back, do a lot of research, you will end up in understanding that the revenue should have been recognized in a different particular manner. And once you enter into it, you agree to revenue recognition positions. It is not easy for you or any startup to change those positions. So I would suggest whenever you are taking up any startup audit, especially when they are into tech sector, do a very detailed review of the revenue model which they are having from a business standpoint. If you understand their business correctly, their product correctly, their tech platform correctly, that is when you will be able to assess the revenue recognition policy for that entity correctly. And it is very important that from day one, the policy which is getting adopted is appropriate policy. Otherwise, they would have the ramifications or implications in the future. You need to educate them how it could impact them. Another aspect is on the ESOP, which I spoke. Generally, they always have ESOP, but they miss out accounting for those. So, such type of schemes need to be appropriately accounted for. Another impact would be around whenever there are these investor agreements which they enter into, the shareholder agreements. Generally, the investors enter into these agreements through CCPS. So, whenever there are Ind AS accounting, etc., which comes um, along or which is not there applicable on day one, but as you go along in the process, they will have to convert themselves into Ind AS. There, these are all at times treated as liability, and then you will see that their net worth, etc., gets eroded. So, all these aspects as an auditor, you have to be an advisor for them, correct? They are not the ones who will understand or preempt all these aspects. Why vis-a-vis a listed company will preempt a lot of implications which it may have to face through. A startup may not be able to preempt. So you will have to think about what is their vision in next 2 3 years and guide them appropriately there. I think there as an auditor, also you also have a role to play as an advisor there for them. Otherwise, they will not be able to sustain. They would not be able to understand why you would want to do. And once you bring all those insights on the table, you will be able to add value to it, and then the founders will be able to appreciate, and you can do the right thing then. So I think that the focus has to be and the effort has to be very high, even if it is a small startup. If you have to be with that startup in that journey and make sure that they do the right thing from day one.
You are very right, Shraddha, well spoken, because the hand holding and as advisor starts from the day one itself. And that is very critical for the startup, the founders to understand the nitty gritty, how we are coming and what is the expectation so that, they don't have a downfall. And definitely the documentation is in place. Could you throw some lights? I was curious to know, the post-COVID era and the pre-COVID era, how your audit approach, again, that question, the tools, the checklist, the other
Yeah.
things have changed because the remote kind of working has you done away. Anything that you would like to
Yeah.
tell the,
So
the
see,
past,
I think
the viewers?
yeah,
Yeah.
as a I think COVID brought a lot of mindset shift to us also as an auditors. So we used to always think we need to be present on the premises to conduct an audit, which was completely, I would say, changed post COVID. However, having said that, so see, one is the location of an employee. I think that doesn't much matter now. You can do a lot of work online, you can do a lot of meetings, etc., client over a Zoom call or a Teams call. But the most important aspect is because of technological evolution which has happened in the industry, we as an audit fraternity also need to evolve on technology, correct? If your clients are using technology like blockchain and emerging technology, you are not able to understand the business by testing samples, correct? One is you need to have technology experts on your panel or on your in your audit team who can understand that technology, test the controls around IT controls around it. That is very, very important. Second aspect is around using tools and technology to do the audit, correct? Lot of data analytics has been started, so a lot of firms have come up with lot of analytical tools, Power BI, Tableau. So if you see, even startup today are doing MIS using the dashboard mechanism, right? Even if they are small, they would want their MIS, which is extremely critical for them, to be completely automated, to be there on the dashboard. So similarly, auditors have also at times gone away with that sampling approach, and they have started looking at the population as a whole, analyzing the population. So a lot of times what we do is we analyze the population, look at the outliers, and then we test those outliers as samples. So you are still doing the sampling approach, but you are testing those outliers, which makes more sense to you. Because now the focus of those charged with governance and audit committee is also moving more towards how you can give me higher level of assurance. So nobody wants to talk about an auditor coming and testing 100 samples and saying, I have only looked at my samples. Everybody wants more focus on the processes and look at the outliers and how you can give them comfort on the overall basis. Plus, I think the regulatory environment has also become a lot of very strict. We have seen a lot of actions, etc., being taken, a lot of companies not doing right things. So, from that standpoint, also with manpower related issue increasing, a lot of people not very focused on audit, considering the risk involved. So, all that put together, it is important that as a firm you embrace the technology, you see how you can optimize whatever you are doing. You can give the mundane task to the technology, and you can focus more on judgment related area. Like we spoke about revenue recognition, it takes a lot of time to understand these contracts, to go through it and then make a decision how you would want to account for the revenue. Correct? So for that, you will have to free up your manpower from doing the routine things. So from that standpoint, also it becomes important that you embrace the technology. So I think yes, there has been a change. Pre-COVID, there was a lot of notion that we have to go to a client location, has to be there physically. That is moved out. Plus, we have also developed a lot of tools and technology like our clients and use those as part of our audit procedures.
Yeah, thank you so much. Why I was more curious to know, because you are definitely focusing more on the IT sector,
Yeah,
and these engineers and technocrats, are way ahead of our, and they are always evolving, coming up with new products.
yeah,
So yeah, yeah. So I will like, can you throw some light upon secretarial compliances?
yeah. So, as I said, from an IT standpoint, laws and regulation becomes extremely important. Similarly, becomes the compliance with the, I would say, Companies Act and secretarial related aspects. So, whenever you do audit, be it IT sector or any sector, especially if you are talking about a listed company or a large scale, even unlisted company, there has to be a lot of focus on compliance with the Companies Act or the compliance with laws and regulation. The most important part, see, we as an auditor would not know every law and regulation, but as an auditor we should put our effort to understand what process management has in place, correct, to capture all these laws and regulation. Nowadays management, lot of companies use softwares, correct, to a compliance related tool wherein they map all the laws which are applicable to them, and then there is a proper mechanism where all the due dates are monitored, what all non-compliances are there are available, people that is put into people's KPI. It is important that you understand that process thoroughly. You go through those reports, you see very critical compliances from a company standpoint, especially compliances like related party. So if you're talking about a listed company, SEBI has a lot of regulation on related party. Already India has some regulations on it. So Companies Act has another set of rules around it. So it's a very vast area. So in secretarial compliance is also things like related party, compliance with all major laws and regulation. These are extremely critical. So first you need to understand management process and then see what is their mechanism to capture any non-compliance. See whether they have reported any non-compliance and then go through all the extremely critical compliances documentation which is available, because a lot of changes have come in last 2 3 years, especially from a listed standpoint. So for unlisted space, the compliances would be still, I would say, comparatively lighter. But from a listed standpoint, SEBI has come up with a lot of changes. So it is very important that you have a discussion with the company secretary, understand from him how he has made sure all SEBI compliances are there. Go through the secretarial audit report, have a chat even with the secretarial audit, what all he has complied with, whether he has given any suggestions, whether that has any implication on the auditor, on you as an auditor, or look at all those aspects and then conclude on it.
Thank you so much, Shraddha. That was a very informative, a discussion, quick discussion on some of the questions. Over to AASV. I'm
Thank
done
you
with
so
my
much, Shraddha ma'am.
question.
Thank you so much, Pooja madam, for wonderfully
Thank
coordinating the webinar. And on behalf of AASB of ICI, my sincere gratitude and thanks towards Shraddha ma'am for wonderfully deliberating the webinar. During the webinar, you have shared your insights as well as knowledge towards the members. It was wonderful webinar. You have covered all the aspects of relating to the IT sector. So once again, thank you so much, ma'am, for sharing your valuable time and giving your kind consent to moderate to deliberate during this webinar organized by WSP of ICI. Hope our members have gained a lot through your deliberation. Thank you so much, Shraddha ma'am. Thank you so much,
Thank
Pooja ma'am,
you.
for your
Thank
valuable
you.
time to moderate this webinar. I also thanks all the participants of today's webinar. Thank you so much. Good evening. Namaste.